The collapse of Silicon Valley Bank is causing shockwaves across the entire business world.
It's called Silicon Valley Bank, and it is one of the tech industry's largest.
The Silicon Valley.
Up to Silicon Valley.
Bank. Silicon Valley Bank and Signature Bank.
This might be the easiest explanation to the Silicon Valley Bank collapse you will ever get. You have probably been wondering what the deal was, and you've come to the right place. On the 8th of March, SVB announced that they had raised $1.75 billion in capital via fundraising. But just the next day, SVB stocks had plummeted, losing over 60% of its value. Of course, when the news got around to the media, people panicked. On the 10th of March, there was a bank run, which had customers withdrawing large amounts of money, and that led to the collapse of the bank. As I mentioned earlier, there were things the bank could have done differently to prevent this from happening. The more I researched the collapse, the deeper it seemed to go. As you're already aware, Silicon Valley is known for being a preemptive technology hub, with a lot of tech companies and startups located there, and a lot more rumored to be migrating there. The Silicon Valley Bank became the go-to bank for a lot of these companies and startups. As the rise of startups was on the high during the pandemic, a lot of money was coming into the bank. Now, the money coming in from these startups was investment capital that would be used to run them. But here's how SVB chose to handle the influx of cash. They invested a large portion of the bank deposits in long-term US Treasuries and agency mortgage-backed securities. But this was not a sustainable plan, since bond and treasury values tend to fall when interest rates go up. Reason number one in a short sentence: SVB refused to diversify. You're looking at a bank that had a high influx of cash deposits, counting from 2020 and upwards, and having to figure out how to invest that money. Choosing to invest in long-term US Treasuries was one thing, but when the Federal Reserve hiked the interest rates to fight the inflation that happened in 2022, SVB got the heat and their bond portfolio began to drop. Something they could have done was to hold their bonds until they reached their maturity date, and the bank might have been able to recover their capital. Prior to investing in long-term securities, the bank used to loan out money for short duration and make profit off the interest rates. Another avenue that would have helped them out was if they had not switched fully to investing long-term. Since they could not liquidate their assets without risking loss of huge amounts of money, and their liabilities were no longer being protected by the option of short-term investments, they were unable to repay their depositors for months. You might be wondering why they could not just hold out until they could recover their capital from the long-term securities. The answer is easy: economic collapse. With the start of inflation in 2022, things got a bit out of hand, and in 2023, bank customers were withdrawing their money in droves. The tech sector had taken a hit since venture capitals were drying up. Since SVB had no cash liquidated, they were practically pushed to the wall trying to repay their customers. They had to sell their bonds at a significant loss, which affected both customers and investors alike. The collapse happened 48 hours after they announced the sale of their assets. But as you already know, that was barely the only mistake they made. Their second mistake was quite an easy one to avoid: media relations. If there has ever been a worse PR fail for an organization, SVB announcing their $1.75 billion capital raising would top the list. When the news got out, word got out on social media that the bank didn't have enough funds, and that just led to a domino effect. In the world of trading in stocks, that's the sort of news and panic that would cause any organization's stocks to plummet to the ground. It was inevitable, and in the end, SVB stocks ended up crashing by 60%. Then came the bank run. For those who don't know what a bank run is, I'd like you to picture a situation where all the customers in the back literally run to the bank to ask for their money back. You have that picture in your head? That seems pretty crazy, yeah? Well, a bank run, or a run on the bank as it is sometimes called, is a situation where many clients of a particular bank go to withdraw their money from the bank because they are afraid it may fall or close down sometime in the future. Here's the thing: SVB is not your usual run-of-the-mill bank. This was a specialized bank for financing venture capital-backed startups and healthcare companies. They were important to the tech ecosystem because they were supporting startups that most banks would not take the risk to fund. They also handled banking services for these same companies when the money started to come in. These were the deposits that went into investing long-term securities. So the bank was handling large accounts, with some accounts holding more than $250,000, which is the FDIC limit. In addition to that, the accounts mostly held working capital that the companies used to handle things like payroll and expenditures. And with them coming to withdraw from the bank, it was not long before the money ran out. By the 10th of March, California regulators shut down the SVB and had them placed under the FDIC. That was the collapse of SVB Bank as we know it. I mentioned earlier that I would let you in on who took the biggest hits from the collapse. The SVB stockholders and investors did. When customers put their money in banks to be saved or for storage, they are usually backed by the FDIC. The FDIC basically insures all deposits by normal clients. So when a situation like a failure or bankruptcy occurs, they can get their money back. Unlike the customers though, investors have no such luck. With every investment, there's a certain amount of risk involved, and investors are well aware of these risks before they proceed with any type of investments. In addition to the investors, a couple of large tech companies had problems retrieving their deposits as well. Companies like Etsy, Roblox, and even Roku, amongst others. Even though the FDIC insures most banks, I mentioned earlier that some accounts had over $250,000 deposited in them, and this is above the limits for which FDIC usually insures. Well, you may ask, is there any silver lining at all for SVB? Short answer, it doesn't seem like it. The American government has chosen not to bail out the Silicon Valley Bank. The consensus is that the bank will stay collapsed, and eventually the remaining assets will go to creditors. Through FDIC, the government did help with the issue of covering all deposits at SVB, except those belonging to shareholding and unsecured creditors. The deposits were transferred to the National Bank of Santa Clara, and by the 13th of March, the former SVB bank customers had access to their money. On the 17th of March, the SVB parent company, SVB Financial Group, filed for a Chapter 11 bankruptcy protection to combat the civil lawsuit from SVB shareholders. Assets will probably be sold off to pay any creditors. Since SVB is now under the control of the FDIC, they cannot participate in the lawsuit. In all of this, what could have been done better? Well, for one, while making the statement regarding their capital raising, the bank could have emphasized less on the losses and assured the media that it was still cash positive. They could have explained the situation with the bonds and the need to hold out for longer to make their intended profit or at least make their capital back. Despite their lack of diversity with how they handled investments, the entire collapse could have been avoided if they had been able to convince their clients and investors that there was a chance for stability and survival, and that would have prevented the bank run that led to their ultimate demise. So folks, with all this taken into consideration, we can see the need for proper financial management when times are good and when they are bad. And if you wish to find out more amazing stories like this, please subscribe and I'll make your wish come true. See you in the next video. Bye for now.